Okay, let's unpack this.
Let's do it.
We are diving deep into the Arthur J. Gallagher Co. Q3 2025 earnings call materials.
AJG, yeah. A big quarter for them.
Definitely. Our mission today is, well, to cut through the complexity. You've got this massive integration effort with AssuredPartners, plus these really selective market dynamics.
Right.
And figure out how they managed yet again their 19th straight quarter of double-digit top-line growth. It's quite a streak.
It really is a phenomenal performance when you look at it. That top line, AJG delivered 20% total revenue growth in Q3.
20%.
Yeah.
Wow.
But it's not just revenue, right? It's also about efficiency. Adjusted EBITDA, that grew even faster at 22%.
Okay.
And the adjusted earnings per share for the combined brokerage and risk management bits hit $2.87. Pretty strong.
That kind of consistency quarter after quarter.
Yeah.
It really suggests they're executing well.
Flawlessly, almost, on that dual strategy they have. Aggressive M&A and, sustainable organic expansion.
And we absolutely have to start with that M&A piece because, they're not just doing small deals here and there.
Oh, no, it's historic scale, really.
How big are we talking?
Well, year-to-date in 2025, AJG acquired over $3.4 billion in estimated annualized revenue.
$3.4 billion.
Billion. Yeah. Just think about that for a second. They've basically acquired about 30% of their entire 2024 revenue base in just 9 months.
That's massive. And the biggest piece was AssuredPartners, AP.
Exactly.
Yeah.
The centerpiece.
Yeah.
That closed August 18th.
Right, mid-quarter. And the excitement around that deal was huge. Management kept saying 1 + 1 will be greater than 2.
It did. They're clearly expecting immense value creation there. And, it's worth remembering AP wasn't some fixer-upper.
No, they were performing well on their own, weren't they?
Yeah, exactly. AP posted 5% organic growth for Q3 before the deal closed. Management talked a lot about their terrific sales-driven culture joining the team.
Okay, so a strong company joining another strong company. But integrating something that big mid-quarter, that must have caused some ripples in the Q3 numbers.
It absolutely did. And that brings us to the first real aha moment in the financials, what they call the timing aberration.
Ah, yes, the accounting puzzle. The thing that hit their adjusted EPS unexpectedly. Can you break that down? How did the timing create such a headache?
Yeah, it's actually fascinating when you get into the weeds. So they closed the deal August 18th. They owned AP for roughly half of Q3, right? About 44 days.
Makes sense. So maybe they initially modeled getting about half the revenue.
That seems like the logical assumption, yeah. You own it for half the quarter, maybe you get about 50% of the recurring policy inception dates, and thus the revenue falling in your ownership period.
Sounds reasonable.
It does. But then they got access to the actual, customer-level data, the policy schedules.
Yeah.
And they realized AP's business is actually pretty seasonal. Yeah. Due to how policy inception dates were concentrated earlier in the quarter, before they owned it, only about 40% of those revenue-triggering dates actually fell between August 18th and September 30th.
So they thought 50%, but reality was 40%.
Exactly. That 10 percentage point gap, that difference, it resulted in an $80 million revenue shortfall compared to what they might have initially estimated for the quarter.
$80 million just from time.
Just from that. And that single accounting item, that nuance, it impacted their adjusted EPS by $0.22.
Wow. That really shows the complexity of integrating something that big.
It does. But, the positive spin is they identified it fast, quantified it. Speaks well of their systems, I think.
Okay, so that's the short-term integration pain. But the long game is the synergies, right? What's the plan there?
Right. Management's looking much further out. They're projecting $160 million in annualized run rate synergies by the end of 2026.
Okay, $160 million.
And then it really ramps up. They see that accelerating to somewhere between $260 million and $280 million by early 2028.
And where do those savings or gains come from?
It's expected to be pretty balanced, actually. Roughly split across 3 buckets. Revenue uplifts, so cross-selling and things like that, workforce efficiency, and then operating expense reductions.
And technology plays a role.
A big one, they said. Deploying new tech and AI tools across the whole combined company is key to unlocking a lot of those efficiencies.
Okay. Let's shift gears then to the other engine, organic performance. Overall organic growth was 4.8% in Q3. Solid, but maybe not spectacular compared to the M&A boost.
Well, yeah, 4.8% is good, not amazing, but they are forecasting full year 2025 organic growth of more than 6%. So Q3 might be a bit lower than the average for the year.
Got it. So looking inside that Q3 number, where was the momentum and where was the friction? Let's start with brokerage.
Sure. So brokerage overall had 4.5% organic growth. but it really depends where you look. The star was definitely U.S. property and
Gee,
casualty.
let's see. Yeah, how did that do?
Robust growth, more than 7%. That's been a consistently strong area for them.
Okay, so US P&C is humming along. Where did things look weaker?
Well, internationally, the retail operations were basically flat organically.
Flat. Why was that?
Management pointed to a couple of things. Less favorable renewal premium changes overseas compared to the U.S., and also lower contingents.
Okay, let's pause on contingents. Remind us what those are.
Sure. Contingent and supplemental revenues, they're basically extra payments brokers get from insurance carriers. They're usually tied to the profitability and the volume of business placed with that carrier.
So if carrier profits dip or volume slows.
Exactly. Those payments can drop. And that seems to have hit the international segment harder in Q3. It's a variable income stream.
Makes sense. It's not directly tied to just selling more policies then. How about employee benefits? That can be a lumpy business.
And it was this quarter. Benefits lagged quite a bit, only around 1% organic growth.
Oof, only 1%.
Yeah, pretty low. But they blamed it specifically on some very lumpy life insurance cases. Big deals that apparently shifted out of Q3 and are expected later, maybe Q4 or beyond.
So more of a timing thing than a fundamental problem.
That's how they framed it. Not systemic weakness, just timing on large specific deals.
Okay. And the last piece, risk management, Gallagher Bassett.
Gallagher Bassett, yeah. That was actually extremely strong, 6.7% organic growth.
Nice. What's driving that?
They cited really excellent client retention and also a good flow of new business wins, in their claims management services. And they expect that strength to continue. They're forecasting Q4 organic for Gallagher Bassett in that same high range, like 6.5% to 7%.
Interesting. One thing that really stood out from the call was how confident management seemed about the overall economy, and they leaned heavily on their own data.
Yeah, that was fascinating, wasn't it? Especially because at the time, the U.S. government shutdown meant official economic data releases were paused.
Right. So AJG's internal numbers became this sort of unique real-time indicator.
Exactly. They explicitly call their internal metrics things like revenue indications from policy audits, endorsements, cancellations, and excellent indicator of the economy.
How does that work exactly, the endorsements and cancellations?
It's pretty simple, really. If a client's business is growing, they tend to add things to their policies that's an endorsement. And they're less likely to cancel policies if a client is shrinking.
You see the reverse. Fewer endorsements, maybe more cancellations.
Precisely. And their proprietary analysis, looking across their huge client base, continued to show solid client business activity.
And it wasn't just solid, was it? Didn't they say it was actually getting better?
That was the key bit. They noted their internal data for October looked even more positive than September. Higher endorsements, lower cancellations.
So their takeaway was?
Pretty definitive. They said they are simply not seeing signs of an economic downturn based on how their clients are actually behaving and reporting revenue. Real-world activity.
Okay. Now, here's where it gets really interesting, I think. The pricing puzzle.
Yes. The insurance market dynamic.
It feels like things are shifting dramatically, not uniform trends anymore. What did the overall global renewal premium changes, the RPC, look like?
Well, the headline number is still positive, but barely, just slightly up. But the really telling thing is, if you strip out the property market, which is falling, then the overall global RPC is actually around positive 4%.
So still increases overall, just masked by property.
Exactly. And management used this phrase, cycles within the cycle. They argued that the old days where pricing was kind of broadly all lines up or all lines down together, those are gone. It's much more granular now.
Let's dig into that bifurcation then. Property pricing was down, you said.
Down 5% globally in Q3.
Why the drop there?
Mostly increased competition among insurance carriers. They seem to have plenty of capital, and they're fighting for business again, especially for those large shared and layered programs and maybe risks that aren't super exposed to catastrophes. They want market share.
Okay, but casualty lines were doing the opposite, still going up.
Precisely. Casualty lines collectively are still firming, up 6% overall.
And within casualty?
General liability was up 4%. Commercial auto, still problematic, up 5%. And umbrella liability, often a sign of broader concern, that was up 8%.
8% on umbrella. Wow.
Yeah. And I'd flag specifically U.S. casualty lines. They were up 8% and have consistently been rising now for 12 straight quarters.
12 quarters of increases in U.S. casualty.
Right. It really signals that carriers still see ongoing pressure and loss trends in those liability areas, they're remaining cautious.
What about other lines like D&O that had been falling steeply?
D&O was only down 2% this quarter, which led management to suggest it might be close to bottoming out.
That would be welcome news for many companies.
Definitely. And just for context, personal lines were up 6%.
Okay, but the detail that really jumped out at me, the one that feels like it tells the biggest story about the market right now, was the split in pricing by client size.
Ah, yes, that was a crucial detail. Absolutely
What
critical.
did they find comparing large accounts versus smaller ones?
This is something every business owner listening should really note. For middle market and smaller clients, the ones generating less than, say, $250,000 in revenue for HHE, their renewal premiums were still up about 3%.
Still facing increases then.
Yes. They're still feeling the pressure from those firming casualty lines and overall structural costs.
But what about the bigger clients, the ones with more clout?
That's where the story flips. For those larger clients, the ones generating more than $250,000 in revenue, their renewal premiums were actually down 1%.
Down 1% for large clients, up 3% for smaller ones. That's a 4-point gap.
It's a profound spread. It strongly suggests that the large corporations, they're using their scale, maybe better data, and tapping into that renewed carrier competition.
To demand and get premium relief.
Exactly. While the middle market is still shouldering the cost increases, particularly from the cautious casualty market.
So basically, how big your company is increasingly determines whether your insurance costs are going up or down right now.
That seems to be the reality, yes. A key insight into the current market structure.
Okay, let's look ahead then. Strategically, management seemed pretty bullish, saying they expect 2026 to look a lot like 2025 for growth. What's underpinning that confidence?
Well, they're clearly betting on the continued strength of that core P&C business,
Yeah.
especially if you mentally exclude the property pricing dip and also the solid performance in reinsurance.
Any potential upsides they mentioned?
Yeah, a couple of things. They think if interest rates stabilize or maybe even drop, that could unlock some of those lumpy life sales in the benefits segment that shifted out of Q3.
Bring those back into play.
Right. And they also see potential upside from those contingent and supplemental revenues we talked about earlier. They noted those are currently growing about 1.5 times faster than the underlying businesses they relate to, which is a good sign.
And we know the M&A engine isn't slowing down just because they digested AssuredPartners.
Not slowing down at all.
Yeah.
They said the pipeline remains extremely robust. They have about 35 term sheets either signed or being prepared right now.
And what does that represent in potential revenue?
About $400 million of annualized revenue
Yeah.
in that near-term pipeline. So still very active on deals beyond the mega ones.
And do they have the money to do these deals after spending big on AP?
Oh, yeah. They made a point of confirming they retain immense financial capacity for future M&A. They estimate about $10 billion available over the next couple of years.
$10 billion. How?
It's a mix. Available cash, future free cash flows they expect to generate, and tapping into investment-grade borrowing. And importantly, that's before they need to start using their stock as currency for deals.
So plenty of dry powder. And it feels like the AP deal maybe changed perceptions too, showing they can handle deals of any size.
That seems to be the strategic win, yeah. Management mentioned that the scale of the AP deal has kind of opened the eyes of other independent firms out there.
Made them seem like a viable partner for anyone.
Exactly. They made it clear AJG is interested in firms of all sizes. They even threw out the number, recognizing there are something like 30,000 independent agents or brokers still out there as potential targets. Big universe.
Okay, so let's try to wrap this up. What does this all mean? You look at the year-to-date numbers for 2025. Revenue up 17%, EBITDA up 25%, organic growth steady at 6.6%.
Stellar results.
It really seems to boil down to successfully running those two strategies in parallel, right? M&A and organic growth.
Absolutely. They managed this absolutely massive integration while keeping the underlying business humming.
Yeah.
And they seem to be using their data, their analytics, really effectively.
Which lets them navigate what seems like a very complex, very bifurcated insurance market right now.
That's the key, I think. The ability to execute a deal the size of AssuredPartners and then immediately pivot to talking about $10 billion in future capacity while also drilling down into why U.S. casualty is up 8% while global property is down 5%. That shows a mastery of both scale and detail.
Managing the cycles within the cycle, as they put it.
Precisely. Using their data, using their capital to manage that complexity. That seems to be the core of their success right now.
The scale is just undeniable. And
Yeah.
thinking about that $10 billion M&A capacity plus the successful AP integration, it really feels like the industry is entering an era where this kind of large-scale consolidation isn't just possible, it's, well, accelerating.
It certainly looks that way.
So maybe here's a final thought for you, the listener, to chew on. If this pace of consolidation continues and the biggest players like Gallagher gain even more leverage and data, what happens to market competition? And maybe more specifically, what happens to the price paid by those middle market clients? The ones who, as we just discussed, are still facing those steady premium increases even while the giants get relief.
A very important question. How does that dynamic play out long term?
Something to watch as this insurance landscape continues to shift.